In this week's update, the new gold run confirmed, blowout earnings results so far, and we'll take a quick peek at the Bitcoin chart. My name's Garry Davis, and as always, this is general advice only in this video. And please remember to like and subscribe to the video. We've had another strong surge on Wall Street in the last week. The S&P is around 4,200 points, which seems quite incredible, up nearly 2,000 points from the lows in March of last year. And we're into, as I've been covering over the last week or two, we're into a seasonally strong period of the year. The US earnings season is coming through. It's early days, but coming through tremendously well. So it's very, very difficult not to be bullish right at the moment. The important thing, though, is not what the fundamentals are really saying, because at the end of the day, we make money on the market because prices are rising. And the trends are being sustained, particularly in the US. That's the most important thing. And despite how many people might think it should be, people worry about debt and the COVID pandemic, and they worry about trade wars, and they worry about all sorts of things. It's a constant battle. But despite what you think it should be in the market, the message is you can't and shouldn't fight the tape. If the market is going up, then that's what you should go with. It's very, very easy to find reasons why the market can't keep rising. But equally, it does, because earnings are growing at a big picture level. And we're certainly seeing that in America at the moment. We're seeing technological advancement at a great rate. And there are new financial paradigms as well. Now, whether you agree with them or not, whether you think that they're sustainable long term, and I'm talking about the new paradigm of monetary stimulus and whether that has an end point. The fact is, in the time frame that is applicable for most investors, there is enormous stimulus out there which is propelling economies and propelling earnings and stock prices, and that's just the reality of it. It's creating one of the best environments for stocks that I think we'll ever see, because we've got low interest rates. We've got inflation that's relatively under control at the moment. Some people are worrying about it breaking out, but there's equally a strong case why inflation will remain relatively benign. We're seeing incredible stimulus around the world. And then on top of that, the process of decarbonisation is just adding a massive new impetus to growth. There are new industries opening up that are attracting enormous amounts of government expenditure, and that's not going to get switched off. Again, whether you agree with what's happening with decarbonisation, the fact is it's now got a life of its own. It's not reversible, and it is going to continue. So that's just the reality of where we're at. And to reinforce this point, I just want to go through some of the sectors and some of the industry groups in America just to reinforce what really good trends look like. So the first one is the US financial sector, XLF. And here's the lows back in March of last year. We had a bit of a rebound because the market had got oversold. We then went sideways until November. But then look at what the banking industry has done since the vaccine came on the scene. It's absolutely taken off, and we've run on the index from 25 to 35, and that's a huge, huge move in XLF. And it's outperforming the S&P, which means it draws in more funds from fund managers who can't afford to underperform the S&P. So that's the finance sector. Now, if you look at opportunities to buy into the finance sector, whenever it dips to between the 20-day and the 50-day moving averages, has proven to be a good time to enter that index. If we look at XLK, we've just gone through a week period where we've had rotation out of some of the more aggressive sectors into some of the sectors that had really been hit hard by COVID. But look at the opportunity that created in technology. Consumer discretionary has been enormously strong for a long, long time now. We had a dip in March, when there was again, this is rotation related, but consumer discretionary has very, very quickly picked up again. Another aggressive sector, communication services, is showing the same sort of pattern. Dips to the 50-day moving average have proven to be extremely good entry points. Let's drill down a little bit into some of the strongest industry groups. This is insurance, the Dow Jones Insurance Index. Look how that's taken off since November. We've run from around 32 to about 48. So we've basically gone up by 50% in the insurance sector. This is investment services. So again, very, very strong trends. So you can just go and find some of the better performers within these sectors. Final couple, this is specialty retailers, and there are many other industry groups. I mean, there's hundreds of industry groups in America. There are many others. These are just, I've just cherry picked a few that are showing enormous strength. Now, this is renewable energy. And as you can see, we had an enormous surge leading into February, and then that's all come to a screeching halt, and it's lost about 50% of its value since then. But this is a long-term theme that's got serious legs, and whilst it's not an entry yet, it's down to a level where you've got to be watching this sector closely for a turnaround. So the message is that you want to go with momentum, and if you're looking for opportunities, then buy dips, whether they be small dips or big dips, in sectors that have got that momentum and that have got those mega trend tailwinds for many, many years to come. So that's a really important message out of this week's update. Now the S&P ended up rising 2.2% across the week, and it's only early days, but the banks absolutely smashed estimates. And we're talking earnings beats of 30, 40, 50% above what was expected. Now in America, Wall Street analysts are all over these large cap companies constantly. They know what's going on. And these are not earnings beats by comparison to the same quarter last year. So, don't think that they're coming in with big percentage increases because it compares to March quarter or June quarter last year, when obviously things were badly impacted. These are beating estimates against the most recent estimates by analysts who are all over these companies. And yet analysts just can't raise their earnings fast enough to keep up. So the bank's results so far have been incredibly impressive, and certainly some of the other industrial companies have as well. And in addition to the S&P hitting a new all-time high, the Nasdaq hit a new all-time high as well. So certainly the trends in America are looking very strong. The US dollar has backed off again. We were forming higher highs, higher lows. Looked like it was going to continue higher, and then it's turned around and gone down now for the last 10 days or so. And the 10-year yield, which everyone was starting to really fret about, and every time the 10-year yield moved up, even the tiniest fraction, technology stocks got sold. That was in March. We're now out of that period. The market is responding more realistically. The yield has come back to 1.58, and as we saw, technology stocks have kicked on very well. And importantly, the VIX is now down to 16. I mean, we were trading in that band above 20 for a long period of time, but now we're down to 16, which is getting back to the sort of 2017, 2018 levels when the market advanced quite nicely without a lot of volatility. Now, I'm not suggesting that there won't be much volatility this time around, because I think there will, but we certainly are getting down to those sort of levels. All right, let's look at some other charts. Just before I go too much further, though, let's just look at, before I forget, the Bitcoin chart. And Bitcoin continues to form higher highs and higher lows. And we've got a breakout. We got a breakout on Tuesday of last week to new all-time highs. Backed off a little bit towards the end of the week. But again, just put aside what you think about Bitcoin and what you think about where the price of Bitcoin should be going, and I have absolutely no idea. I'm just looking at this from a purely technical chart perspective. We are forming higher highs and higher lows, and dips to somewhere between the 20-day and the 50-day moving averages have proven to be extremely good buying points. And you can only really go with what is. You know, if you try to second guess that the market is going to change direction or do something different, then you're absolutely on the wrong leg all the time. Or not all the time, but occasionally you might be right. Why wouldn't you want to do something where you're right most of the time? And so therefore you look at the chart and you just keep doing what has proven to have worked. And in this case, dips to the 20 or 50-day moving average on Bitcoin have proven to be buying opportunities. So just do that if you're into Bitcoin. I'm not, but I cover this because there's obviously a great deal of interest in Bitcoin these days. Okay, let's look at the S&P. So this is the big picture. This is the monthly chart going all the way back to 1967, right over on the left-hand side. And you can see that the blip we had in March of last year is starting to look like just that, just a blip on the long view of the market. But if we look at a reasonable time period for what most people are active in, then again you can see the S&P has been on a very strong breakout since November, and has advanced. It's probably a bit overbought technically at the moment, so I wouldn't be surprised to see a bit of a pullback. But seasonally, from now until the middle of May, so we've probably got another 4 weeks of seasonal strength. Now that doesn't mean that the market and the indices will just keep advancing for that whole period of time. It doesn't mean that at all. But what it means is that between now and the next 4 weeks, the overwhelming odds are that the indices move higher. And that's just based on history and seasonality. It's a fact. But it doesn't necessarily offer us any guarantee. So you still need a good risk management plan and a good entry plan for what you're doing. And if we look at the NASDAQ, then that has also moved to new all-time highs. Obviously, it's playing catch-up to the broader market. But yeah, we're now back at all-time highs on the NASDAQ as well. If we look at some of the key spreads that I like to look at regularly, this is consumer discretionary versus consumer staples. You can see we're almost back to all-time highs now. Money is has certainly coming back into those sectors after a bit of a dip, the more aggressive sectors. And if we look at this key one, this is the Russell 1000 growth versus 1000 value. We had a breakdown from support. We got down to the next level of support in early March, and then we quickly turned around. We need to see this line continue to kick on, but I think with technology earnings coming through in the next 4 to 6 weeks, I think we'll see this line continue to get back up into this upper range here. So things are looking pretty positive when it comes to the American market at the moment, and particularly the more aggressive sectors. Okay, let's just look at the currency quickly. So this is the US dollar. So higher highs, higher lows, and then just when you start to think we've got an uptrend on our hands that's going to be sustainable, we get a bit of a breakdown. Now we haven't broken these lows through here yet, so it's not necessarily all over for the US dollar. I think where it sits at the moment is really, it's just in neutral. I wouldn't want to call the US dollar either way. The fact that we've now come back down and retested these lows is certainly indicating that this uptrend is not as strong as we might have thought 2 weeks ago. I think that's probably about all you can say at the moment. So a bit indeterminate with currencies. And as a consequence, the Australian dollar has really just gone sideways relative to the US. We're just a tick under 77 cents. Turning now to the Australian market, so 76.92 is where we finished. Our index put on 1% for the week. But look, the earnings growth, our market is very different to the US market when it comes to the larger cap stocks. We're seeing just incredible earnings growth. This is real growth. This is not manufactured earnings. It's not expectations. This is real growth coming through that is absolutely smashing analysts' forecasts that were made even just a week or two ago. In Australia, the earnings growth is really centred more in small and mid-cap stocks. Our large cap stocks are really going to struggle to grow earnings at anything like the rate of the US large caps. Now, I'm not saying our large caps won't grow, they will, but it's going to be a lot slower than the US large caps. And so for our large caps to go up significantly, I believe, we're going to have to see multiple expansion, whereas in America, we don't have to see that. Earnings are growing so robustly that prices can just go up at effectively a level PE ratio. Whereas in Australia, I think for our large caps to go up to that degree, the PE multiples are going to have to go up. And that, of course, leads to overvaluation and a lot more risk in the market. So for me, the lower risk, I know there's more volatility in small caps, but the lower risk is certainly where the growth is. And in Australia, that's in the small cap space. So we'll just look quickly at the ASX 200. So you can see we've broken out above this little consolidation we had. The all-time highs in February last year, which was around 71.86. So we've still got a little bit of a way to go. We finished at 7063, so another 100 points to get to the all-time highs. But certainly, things looking reasonably buoyant in Australia. And there is no question that some of the industries that were badly affected by COVID are now opening up again. And so, the outlook is a bit better. But to me, America is where you've got the real growth that'll provide that sustainable rise in stock prices. And I've showed this chart last week. I'll just touch on it again. Whilst the growth and the long-term outlook for small caps is in that area, this is the reality, particularly with very early stage small caps, pre-profitability. You get these amazing roller coaster of price action that you need to be aware of. And so you need a very clear plan around how you get into stocks and how you manage them along the way, because it can be difficult, to live with that sort of price fluctuation if you're just stumbling into the market any old time. Turning now to precious metals, gold had a real spurt, put on $33 to get up to $17.77. So how things have turned around in the precious metals space. Silver also rose up to $25.66. And I think the capitulation selling that we saw in late February based on the futures leverage has now reversed itself. Looking at precious metal stocks, on an historical basis, they are significantly undervalued. There's no question about that. The multiples on whichever ratio you want to look at are significantly below the long-term averages. Now, that doesn't mean that prices will go up, because we've been in that situation now for probably 6 months. So the fundamentals have not been reinforced by the price action. In fact, the price action has gone the other way because of the particular dynamics around the futures market. But the momentum has now swung back. And I covered this last week. GDX has started to move up, and that was only reconfirmed during the week, where we got a confirmation of that breakout. And if you look at one of the important ratios, and that's the ratio of GDX to the gold price, it's pretty close to its historical lows. So that ratio has to play catch up. And if gold is also going up and the ratio is going up, then you can see the potential for gold stocks if this momentum is sustained. So we'll look at silver first of all. So silver, which was outperforming gold for a long period of time, is really sort of underperforming a little bit in the short term. But I'm not terribly concerned about that. The outlook for silver, because of industrial and technology applications, looks pretty good. This is gold on the weekly basis. So you can see we've quite clearly got a turn up now, and that happened right off the 38.2% big picture reversal point. So that's taking it from the top in July, August of last year, and the bottom, which occurred in 2018. So we've come down a bit over a third, first Fibonacci level, and we've bounced off that pretty nicely. And you can see that that's looking pretty good. And also on the daily chart, you can see we've now got higher highs, higher lows, and we've now got semblance of a sustainable uptrend. If we look at GDX, you can see that where were we last week? When I did the video last week, this is where we were sitting. We'd had a very, very minor breakout in GDX to a new high. We did pull back on Monday, but from then on, it was very positive. And Thursday and Friday, GDX finished off the week very, very nicely. So all you can say here is that, I guess, two things. We now have a clearly defined uptrend. There's no question about that. And secondly, GDX, when it runs, as I covered last week, the typical distance that it travels on average, it runs for about 6 to 8 months, typically in an up leg, and the average gain is around about 100%. Now, that is not a prediction of what will happen this time. It could be more, could be less. It mightn't get going at all, as it didn't in December of last year. But certainly the signs are looking more positive this time round. Turning to other commodities, copper rose to $4.20, which was largely around the currency. But interestingly, nickel was down a little bit. So the two base metals going in opposite directions there. I guess copper is really about the decarbonisation and all the infrastructure building around the world, whereas nickel, not so much to the same degree. The outlooks for base metals, though, remains very strong if you look out over the next 2 to 5 years. Crude oil also bounced back, helped a bit by the currency, of course, back to 63.1. There's the spot copper chart, so a strong week for copper, flat for nickel. So wrapping it up, my final thoughts, just one thing to be aware of, a lot of stocks in the US will run higher into earnings. So buy the rumour, sell the fact. The Wall Street analysts are out there talking to these companies constantly. They know what the earnings are likely to come through, which is really why it's a bit of a surprise as to why so many companies are absolutely smashing analyst estimates when the analysts are out there talking to them all the time. But look, often the prices will run up into earnings, particularly with technology stocks, and then we can get a sell-off. Unless the earnings report and the guidance outlook is really, really strong, there can often be a sell-off. So you just want to be careful buying into a strong earnings report, particularly if the price has gone up leading into that report, because often that is as good as it gets in the short term. So just be very wary about buying a strong earnings report. What you want to do is you want to buy the dip before that run-up starts, which can quite often be 4 to 8 weeks before. Now, the next 6 to 8 weeks are seasonally one of the strongest periods of the year. That is a fact. Whether it will prove to be again this year remains to be seen, but this is as good an environment for that seasonality to come through that I've ever seen, looking back over the last couple of decades. So if seasonality and historical trends and fundamentals mean anything, then the next little period should be pretty good. And then in addition, we've got all these new tailwinds. We've got just extraordinary government stimulus like we've never seen before. The amount of infrastructure building that's going to have to go on around the world, and not just in roads and ports and those sorts of hard infrastructure areas. You know, the build out of 5G around the world is just going to be a phenomenal exercise that goes on for the next decade. A lot of these new technology areas are going to require a lot of infrastructure to be built. And then, of course, you know, we've got low interest rates and you know, all the other things that are adding tailwinds. But particularly in Europe, the incredible support that the government is lending to decarbonisation. You know, it's just creating so much momentum in so many different areas. The best time to buy for most sort of growth stocks is the dips that precede the earnings in the overall strong uptrends. And if you go right back to the start of this video, when I looked at the strongest sectors in America and the strongest industry groups that had momentum, you know, if you buy the dips in those sort of areas, the strongest sectors, then you're generally in pretty good shape. Portfolio analyst last week, we covered several buying opportunities in Australia and the US. There's a lot of great opportunities, but I also covered the realities around how and why prices move, because sometimes prices do seemingly illogical things. And I think it's really helpful if you understand that there are dynamics at play that have nothing to do with the stock. They have nothing to do with the fundamentals or the valuation or anything being wrong. They're just short-term dynamics that if you understand them, you can use to your advantage. So, you know, that's a bit of an ongoing theme, because I think the more you can understand about why prices move, the better you can take advantage of that. That's it for this week. There's my website address with there's more information there about what we do, and there's my email address for anyone that wants to contact me. So that's it for this week. I would expect another fascinating week, and I'll be back with you next Sunday. Cheers.